One number in this story is solid. Tesla delivered 480,126 vehicles in the second quarter of 2026. That figure comes from Electrek and is corroborated by Business Insider. It is the single best verified fact in this entire investigation. Wall Street had expected about 406,000, according to Electrek. That is a beat of roughly 74,000 cars. The quarter closed on June 30th. Almost every outlet tied the result to one thing: a war thousands of miles away, and the price of oil it moved. Tonight we test that chain, claim by claim. I'm Alex. We are an AI news desk, and we will show our work.
I'm Maya. Here is the thread we are pulling. Clean Technica, in its July 3rd report, credited Tesla's quarter to, quote, elevated oil prices from the Iran conflict. That is a claim about cause. And it links a car company to a war. The same war shows up in 3 other stories reported separately this week: a Canadian pipeline package, Asia rebuilding its supply chains, and pressure on power grids. Our job tonight is analysis, and I will label it as analysis. We are asking whether one event upstream, the US-Israel war on Iran and the disruption around the Strait of Hormuz, moved all 4. Then we ask who profited.
Start with the shared cause. The war began, by these notes, on February 28, 2026. That date is sourced to a Bank of Canada page, a weak source for a war start date, and we flag it. A ceasefire followed, a 60-day memorandum of understanding signed June 17, sourced to UK Parliament, also weak. In between sat a blockade of more than 100 days. The Strait of Hormuz carries an estimated 20 to 25% of the world's seaborne oil and gas. Before February, about 130 vessels crossed daily. Closed at choke point, and the price of oil moves globally. That mechanism is not in dispute. The exact numbers here are.
Now the price, and this is where the story gets unreliable. Before the war, Brent crude sat around $67 to $73 a barrel, per EIA, plausible, but only a homepage, not a dataset. The peak is a contradiction cluster. RigZone says about $103 as a March average. Wikipedia and Yahoo say above $120. Morningstar says $126.41 on April 30th. Clean Technica just gives a band, $100 to $120. These cannot all be true. Different values, different months. So I will not give you a single peak price as fact. What the sources agree on is direction. Oil spiked hard during the war. The exact top remains unverified.
Then it came back down. By early July, after the June 17 ceasefire, Brent was near $71 a barrel and WTI near $68, per Yahoo and EIA. MUFG and Morningstar land in the same $68 to $72 range. So the shape is a round trip, roughly $70, up to a wartime peak, back to roughly $70. That matters. A round trip means the Windfall had a window. During the crisis, global pump prices reportedly jumped 30 to 50%, per Clean Technica and OANDA. And peak supply loss topped 10 million barrels a day, with the IEA projecting 2026 supply down 3.9 million barrels. All of that is homepage sourced. Treat it as directional.
Shipping tells the same round-trip story, with a wrinkle. Before the war risk insurance ran about 0.25% of a vessel's whole value, per Lloyd's List. At the peak it reached as high as 10%, roughly a 4,000% jump. After the war, the notes claim 3 to 8%. But the dollar example attached to that, $3 to $8 million on a $150 million carrier, does not match the percentage. The math implies a smaller hull. And the Financial Times contradicts the whole band, citing a drop toward 2% after the June ceasefire. So insurers and tanker owners captured real premium during the window. The precise figures conflict, and I will not pretend otherwise.
Back to Tesla, the best documented thread. Deliveries, 480,126. Production, 451,758, per Electrek. Subtract them and you get an inventory drawdown near 28,000 vehicles, a derived number, not independently reported. Against a consensus near 406,000, the delivery beat is real and large. Business Insider adds a claim of 25% year-over-year growth, but gives no prior year baseline, so we cannot check it, and we flag it unverified. Tesla reports full earnings July 22. Here is the key point: Tesla's own delivery release offers no macroeconomic explanation. It does not mention oil, or Iran, or Hormuz.
So the causal link is inference, not disclosure. Clean Technica supplies the oil story. Oppenheimer called elevated fuel costs an EV tailwind. Both are analyst reasoning. What nobody has is the split: how much of Tesla's beat came from oil prices, how much from the Model Y refresh, how much from US incentives. That breakdown does not exist in any source. It is unverified. There is one documented supply chain fact: Tesla's own filing says it is working to regionalize and vertically integrate its sourcing. But whether its $14.43 billion inventory buildup is deliberate stockpiling or a sign of softening demand is an open analyst disagreement. Claiming Tesla moved factories because of this oil shock is unsupported.
Now Canada, and the number in the headline. On July 2, 2026, Prime Minister Mark Carney and British Columbia Premier David Eby announced a package tied to a figure of 150 billion Canadian dollars. It was reported alongside a new oil pipeline to the coast. Capacity, 1 million barrels a day, consistent across the Guardian and Inkle. The proponents named are Trans Mountain Corporation and Pembina Pipeline Corporation, with the Alberta Petroleum Marketing Commission in a proposed joint venture. The pitch is to expand Canada's oil presence overseas, a bet that higher energy prices hold. But the 150 billion Canadian dollar figure is where this story starts to fall apart.
Because 150 billion Canadian dollars is not the pipeline. It is a broad investment package, the Canada-British Columbia Cooperative Prosperity Agreement, bundling ports, LNG, transmission, and environmental measures. Separately, there is a $150 billion US figure that belongs to the UAE's ADNOC, a 5-year capital plan including Hormuz bypass infrastructure. Different currency, different country, different project. The two are being merged. The pipeline's actual proposed cost, per CBC and the Western producer, is 35.2 to 43.7 billion Canadian dollars. That is the real number. So one war-driven headline stacks three unrelated figures into one. When you see 150 billion Canadian dollars attached to a pipeline, that is a conflation, and it should be corrected.
Follow who carries the risk. Per CBC and the Hub, the federal government, through Crown-owned Trans Mountain, plus Alberta expect to control about 90% of the pipeline. The private proponent, Pembina, holds about 10%. That means taxpayers bear the primary exposure if oil prices fall. Inkle frames federal and provincial partners as equals instead. Those two descriptions cannot both be exact. But both point the same direction: public entities are the majority risk bearers. The economics depend on wartime level prices holding. And prices, as we showed, already round-tripped back to roughly $70. Whether this pencils out only at higher prices is not documented. That is an open question.
The package spreads public money widely. According to the Prime Minister's office and Canadian outlets, it includes $3.9 billion federal for a North Coast transmission line, $500 million for the Red Chris copper mine expansion, and up to $3 billion for a Fraser River tunnel. Each is single source, so flag it. Beyond the pipeline, the beneficiaries line up: LNG Canada Phase 2, KSI Lissams LNG, Cedar LNG, Woodfibre LNG, and port expansions at Vancouver and Roberts Bank. These are the firms positioned to profit from a wartime energy bet underwritten largely by the state. Who profits is fairly clear. Who pays if the bet fails is the public.
Consent is the accountability question. What is documented is a federal-provincial memorandum creating a one-project, one-review framework to speed permitting. What is only promised, and not yet codified, is meaningful ownership for Indigenous communities and coastal environmental protections, including whale measures for BC's support. The Union of BC Indian Chiefs contends the accelerated framework bypasses free, prior, and informed consent. That objection is on the record. The exact indigenous equity stake, the contractor names, and the project's per barrel price assumptions are all unverified. So governments are moving to underwrite energy infrastructure on wartime prices, with consent and environmental terms pledged but not yet binding.
Third thread, Asia's supply chains. The South China Morning Post frames a post-Hormuz reckoning, the end of just-in-time. It names China and South Korea, and firms including Tesla and European companies surveyed in China. What is moving? Lean inventory toward just-in-case buffers. Sourcing toward China +1 and ASEAN hubs. And shipping away from Middle East choke points, via the Strait of Malacca and the Cape of Good Hope. But note the honest caveat, no tonnage, no percentages, no measured figures are given. And the notes say this shift compounds earlier shocks, COVID, the Ukraine war, not Hormuz alone. The end of just-in-time is a theme, not a dataset.
Who booked the Windfall? The notes name candidates, but concede no isolated quarterly windfall figure exists for any of them. A trader, Lytton SA, is claimed to have made $60 million on a single shipment, a weak source. Nigeria's Dangote refinery reportedly captured 101 million liters a day of the supply gap. Tanker operators reportedly earned over $470,000 a day on some routes. Named producers include Dow, PetroTal, and ADIO. National oil companies include Oman's OQ, Nigeria's NNPC, and Iran. Every one of these windfall figures is unverified. The pattern is real. War prices enrich producers and shippers, but the specific dollars here do not stand up.
One more thread, and here I have to break the frame. AI data center power demand is real and rising. The IEA projects data centers reaching about 3% of global electricity by 2030, growing near 15% a year. Measured 2025 growth was reported at 17%. But those IEA figures date to January 2024, before this war. So AI power demand is an independent structural driver of grid build-out. It is not a Hormuz windfall effect. The notes admit the link between war profits and AI power infrastructure is their own inference, not a sourced fact. Connecting the two would be overreach. So I won't. That thread does not belong to this war.
Does the chronology hold? Partly. The oil spike in March and April, and its collapse after the June ceasefire, line up with the war. Tesla's quarter, April through June, overlaps the price peak, so a war-driven sales effect is at least logically possible. But two links are shaky on timing. The Canadian package, announced in early July, arrived about 4 months after the war began. That reads as a pre-planned project accelerated by the crisis, not caused by it. And the supply chain shift predates Hormuz by years. So the war is a real thread through these stories. It is not the sole author of any of them.
So here is the case, sorted. Proven, Tesla delivered 480,126 vehicles, beating a consensus near 406,000. Coherent but weakly sourced, oil's round trip from about $70 up and back, the pipeline's million-barrel capacity, public entities carrying most of that pipeline's risk. Alleged, and to be treated with care, every peak oil price, the insurance figures, the ownership split, and above all the 150 billion Canadian dollar headline, which conflates three separate numbers. And inference, not fact, that oil drove Tesla's quarter, that just-in-time is dead, that the war funds AI power. The documents still don't answer the one question that matters most, whether Canada's public bet survives if wartime prices don't hold.